Most traders know where they want to buy and sell. The real challenge is finding the exact area where a reaction is most likely to begin, because entering too early often leads to unnecessary losses, while entering too late means missing most of the move. In today's video, I'll break down two completely different trades that solved this problem for me. One was a buy setup, one was a sell setup, and despite moving in opposite directions, both trades followed the exact same framework and delivered a clean 1-to-3 risk-to-reward move. So let's start with the first chart and see how the entire setup came together step by step. Let's start with the first chart. The first thing I identified was this supply zone, and this wasn't my entry area. Instead, it was my high-probability target zone. Now, many traders focus only on finding where price might reverse, but I wanted to know where the market was most likely to react before reaching this target. To answer that question, I needed something more than a simple zone, which is why the next step became very important. So instead of guessing where price might react, I applied a fixed-range volume profile to this entire move. The purpose of the volume profile is simple. It shows us where the market spent the most time and where the majority of trading activity actually took place. This is important because not every price level inside a move carries the same significance. Some areas attract very little interest, while others become major areas of acceptance. And once the volume profile was applied, one specific level immediately stood out from the rest. That level was the point of control, also known as the POC. The POC represents the price level where the highest amount of volume was traded within this entire range. In other words, this is the area where the market showed the greatest level of participation and acceptance. Now, this doesn't mean price will automatically react from the POC every single time, but when a significant amount of volume is concentrated around one level, it becomes an area worth paying close attention to. So, instead of entering immediately, I wanted to see how price would behave once it returned to this level. As price approached the point of control, something interesting started to happen. Instead of rejecting the level immediately, the market began to consolidate around it. This tells us that buyers and sellers were actively exchanging positions, creating a temporary balance in the market. Now, many traders make the mistake of entering during this consolidation phase, assuming the POC alone will hold. But I wasn't interested in anticipation. I was waiting for the market to reveal its intention first, because confirmation always carries more weight than prediction. After the consolidation, the market finally started to reveal its intention. We can see the formation of a fair value gap, which is created when price moves aggressively and leaves an imbalance behind. This imbalance is important because it shows that buyers were willing to push price higher with enough strength to leave inefficient pricing in the market. Now, the fair value gap itself was not my entry signal. What caught my attention was the fact that this imbalance formed right around an area that I was already monitoring. At this point, I had a potential setup, but I still needed one more piece of confirmation before considering an entry. At this point, I wasn't interested in chasing the move higher. Instead, I wanted to see whether the market would respect the fair value gap that had just formed. As expected, price retraced back into the imbalance, but this time it didn't return with weakness. It returned with strong bullish displacement, showing that buyers were still in control and willing to defend this area. For me, this was the confirmation I had been waiting for. I had volume supporting the idea through the point of control. I had an imbalance in the form of a fair value gap. And now I had displacement confirming bullish intent. With all three factors aligned, the setup was finally ready for an entry. With confirmation now in place, I executed my entry directly from the fair value gap. My stop loss was positioned below the area that would invalidate the bullish setup, allowing me to define my risk before entering the trade. As for the target, I wasn't guessing where price might go. I was simply targeting the supply zone that I had identified at the beginning of the analysis. This gave me a clean 1-to-3 risk-to-reward setup, where the potential reward was 3 times greater than the amount I was risking. Now, while price was moving toward the target, There's an important lesson here that many traders overlook. The reason this trade worked wasn't because I found a magical entry pattern. It worked because multiple factors aligned before I entered the market. First, I had a clear target in the form of the supply zone. Second, I identified an important volume-based area using the point of control. Third, I waited for the market to create an imbalance through the fair value gap. And finally, I waited for displacement to confirm that buyers were actually stepping into the market. Most losing trades happen when traders skip one of these steps and enter based on anticipation alone. By allowing the market to confirm the idea first, the probability of the setup increases significantly. And as you can see, price continued higher and eventually delivered the full 1 to 3 risk to reward target. Now that we've seen how this buy setup developed, let's look at a completely different market scenario. What's interesting is that the next trade was a sell setup, yet the framework remained exactly the same. I still started with a high probability target zone. I still used volume profile to identify the point of control, and I still waited for confirmation before entering. The only difference was the direction of the trade. So let's break down the second chart and see how the same process produced another clean 1 to 3 setup. Before looking for an entry on this chart, I first wanted to understand where price was most likely to move if the setup played out. Rather than focusing on where to sell immediately, I started by identifying a logical target area based on the market structure. This gave me a clear objective before I even considered taking a trade. Once the target was established, the next step was finding a high probability area where sellers might become active, and that's where the analysis began. The first thing I identified on this chart was this demand zone. Just like the supply zone in the previous example, this wasn't my entry area. Instead, it was my high probability target zone if sellers managed to take control of the market. Having a predefined target is important because it gives structure to the trade before an entry is even considered. Now that I knew where I wanted price to move, the next step was finding a high probability area where a bearish reaction could potentially begin. To locate that area, I once again applied a fixed range volume profile to the move. This allowed me to see where the majority of trading activity had taken place and which price levels attracted the most market participation. Once the profile was applied, one level immediately stood out from the rest: the point of control, or POC. As we discussed earlier, the POC represents the price level with the highest traded volume within the selected range. And when a large amount of volume is concentrated around a specific price, it becomes an area worth monitoring for a potential reaction. So rather than entering immediately, I wanted to see how price would behave around this level first. As price approached the point of control, the market began to slow down and consolidate around the level. This was important because it showed that the POC was being respected rather than ignored. However, just like the previous trade, consolidation alone wasn't enough for me to enter. I still needed a clear sign that sellers were stepping into the market before considering a short position. At this stage, there was one key difference compared to the previous setup. I didn't have a clear order block or fair value gap to work with. So instead of forcing a setup, I focused on the most recent area where sellers had previously shown strength and marked it as a supply zone. This gave me a logical area to monitor if price decided to retrace higher. Now the question was simple. Would sellers defend this zone when price returned, or would the market continue pushing higher? Eventually, price retraced back into the supply zone that I had marked earlier. This was the area I wanted to monitor because it represented the most recent location where sellers had shown interest. As price entered the zone, I wasn't looking to sell immediately. Instead, I wanted confirmation that sellers were actually defending the area. That confirmation came in the form of a strong rejection wick, showing that attempts to push price higher were being aggressively rejected. With the supply zone, the point of control, and the rejection confirmation all aligned, I finally had a valid bearish setup. I entered the trade after the rejection candle closed, placed my stop loss above the zone, and targeted the demand zone below, giving me another clean 1 to 3 risk to reward opportunity. As price moved toward the demand zone, there's a different lesson worth taking from this trade. Notice that this setup didn't look exactly like the previous one. In the first example, I had a fair value gap and displacement for confirmation. On this chart, there was no clear fair value gap and no obvious order block. Instead of forcing the market to fit my rules, I adapted to what price was actually showing me. The supply zone provided the location, and the rejection wick provided the confirmation. This is something many traders struggle with because they become attached to a single pattern. But the goal isn't to find the exact same setup every time. The goal is to follow the same framework while allowing the market to present different forms of confirmation. And in this case, that flexibility helped deliver another clean 1 to 3 risk to reward move into the demand zone. The key takeaway from both of these trades is that the entry was never the starting point of the analysis. Everything began with identifying a logical target, understanding where the highest concentration of volume existed, and then waiting for the market to provide confirmation. In one example, that confirmation came through a fair value gap and displacement. In the other, it came through a strong rejection from a supply zone. Different confirmations, but the same framework. If you can focus on process rather than prediction, you'll start seeing the market with much more clarity. Thank you for watching, and I'll see you in the next breakdown.